Hey guys, welcome to Make Money Count. Today I'm here again. Very excited.
You're going to be here forever. From now on,
happy.
You're going to always be here.
That makes me happy.
The problem is that when Austin first got started, I was worried that you might be too much for him.
Oh, because
you're a big personality.
I am a big personality. Austin loves me though. He's very happy with me. I can tell. He's
no response.
He's nodding his head yes right now. Today we're going to be talking about B mortgages. We're going to be redoing an old well, not redoing, but kind of building on an old podcast we did back when our cameras were grainy. And we
you know
were
what the best part about that podcast was? Because I looked at it after we spoke.
Is that my hair looked exactly like Tom Selleck's?
Nothing about you looks exactly like it looks now. And that's not even what I was going to say. And honestly, maybe this time, because the last time I asked Austin to do it and he didn't do it. But maybe, Austin, this time what you could do for me is you could take a little clip from that and insert it now. The part where Justin and I are going back and forth saying, B mortgage, B deal. Oh yeah, B deal, B deal. Listen, it was a really funny show, and but it also had a lot of information. And what we're going to do today is we're going to compare getting a B mortgage from a B lender to getting an A mortgage from an A lender. And many times when one bank declines one of our borrowers and they come to us, so you may find yourself in this camp, like you've gone to your bank, which has been the provider of all of your financial information and all of your financial products for an extended period of time, and they say no to you. Many people are shocked. They recoil. They're not sure where to turn. In actual fact, there are so many lenders in the marketplace right now, and the credit spread for people who may not fully qualify for a mortgage with their income or credit, the spread, so the difference between rates for those people and rates for people that like perfectly qualify with credit and income are tightened. They're much, much smaller than they've ever been before. So it's a really good time to start talking about what other options are available to people who are kind of in the middle of this cash crunch, economic change that we're dealing with right now.
Right. And before we get into it, I think you're going to do a little bit of a market update, which is my favorite time of the podcast.
Is it actually, or are you just like...
I mean, I like it. I learn things. Okay. And so is everybody else here.
Okay. Market update.
Okay.
Market update for the 15th of May, 2024. I will say this again. I said this last week. Cracks are forming, right? Cracks are forming in the economy right now. And there are a few things that we can look at. Austin, if you want to pull up the bond yields chart that I love to reference all the time. Government of Canada 5-year bond yield has fallen about, I think today it fell about 10 to 15 basis points.
It's great news for fixed rates.
Yeah. I mean, so you're like an economist now, basically. Like, you know exactly what's going on. When I say these things, you're like, yeah. So bond yields have fallen. They were like in the 377. They were touching 3.8%. We're now back to like 3.65. Expect bond yields to continue to come down. It won't be a straight line, but Government of Canada bond yields will start dropping, and that's going to result in lower and lower fixed rate mortgages. Probabilities for the June rate drop are still not great. So, and we've been saying this for some time now, do not expect the Bank of Canada to drop the overnight rate 25 basis points in June. July, I think we're going to see a drop because they're going to have a little more economic readings. Anecdotally, we know RBC and TD, Canada's two largest banks, reported that consumer spending is down significantly and it's trending lower. So that speaks to consumer confidence. It speaks to the overall health of the economy. When consumers stop spending, the economy continues to slow down. And then housing, because housing is the Canadian economy right now. It's the largest contributor to GDP. Unfortunately, housing sucks. Housing starts have dropped. So, and the fact that CMHC is reporting that housing starts have dropped should be the most clear indication to every policymaker that you cannot fight interest rates. So the idea of announcing, these multi-billion-dollar programs to throw money at creating affordable housing and to incentivize developers to build rental properties, discounting the GST, none of these things will work until interest rates come down, unless there was some program that reduced interest rates artificially, in which case had the Government of Canada absorb even more of cost associated with developing housing. Fundamentally, the system's broken right now. And in order to fix it, the government can't just throw more money at it. It's just going to be more of a waste. So housing starts are down, listings are way up. So listings are now flooding the market, and sales are low, and sales are going to continue to be low. So home sales will continue to be low. And this is typically the best time in the market, right? Like this is typically the frothy time when everyone's entering the market. It's warm outside. Everyone starts trying to buy a new house. It's not going to happen this year. And the driver's interest rates.
You know what's interesting that I'm seeing these days, which I haven't seen in a while? So many purchases conditional on the sale of the other party's property, which is insane.
Yeah.
Like you would never have gotten that a couple of years ago. Unheard of.
Yeah. It's a hell of a condition too.
Yeah.
It's basically like, hey, I'll buy your property if I don't change my mind.
Yeah,
Because
exactly.
the sale of your property is conditional upon whatever price you determine you want to sell it for.
Yeah.
So yeah, no, it's anyways, that's all I have to say, right? CPI numbers in the United States cooled a little bit. I don't think we can expect the United States to start dropping interest rates anytime soon. Canada, on the other hand, will need to drop interest rates. And it's like a game of chicken, right? The Bank of Canada doesn't want to do anything until they see that the economy is sufficiently broken. And the economy, the moment the Bank of Canada does drop interest rates, is expected to bounce back. But the longer we leave the economy with these interest rates that are highest they've been in 20 years, the more of a problem it's going to be to resuscitate, right? You know, like if you like get caught in an avalanche and you're buried under a whole bunch of snow, if your buddies can get you within a few minutes, they can bring you back to life.
Right.
But if they can't, after a certain period of time, it's going to be a hell of a lot more difficult.
Yeah, of course. And a quick question, actually. If Canada, so this is, if just listening to you talk, like if Canada pretty much does everything that America does, economy-wise, in terms of interest rates and stuff like that, like generally we follow the same path. Why is it that America is doing so much better right now than Canada? Like what's the big difference?
Productivity.
Right.
The American worker is more productive than the Canadian worker. And we talk about this all the time. The spending on infrastructure hasn't been there in Canada. We don't do enough to support our worker to make them more productive. And that's like a systemic issue.
Right.
The United States has a massive economy, a massive global presence, and their government has helped to encourage further growth. Whereas in Canada, I mean, we just announced we're going to have a pipeline that's going to help us release our crude to the west coast of our country to get it into more markets. But up until now, our oil producers have had to ship all of our oil south, where 6 refiners process it in the United States and then sell it out to the market.
Right.
Canada's like a little captive market, and we're not doing anything to change that.
Right.
All we've been doing so far, like for the last 20 years, is stimulating the growth in housing. And now our problems are coming back to haunt us.
Interesting. Well, should we get into some slides?
Let's get into the art of the B deal. So before we get started, and we got to preface this because when customers call, it's always like, I want an A deal, right?
Mm-hmm.
It's not, there's nothing wrong with a B deal. Like I said this to start off the last show that we did 3 years ago. Like I've done B deals for myself. I'm a B deal guy.
I'm a B deal guy too.
Yeah. It's confusing to me that the B deal has such a bad rap sometimes.
Right.
And especially considering this spread compression that we've been talking about.
Well, okay. So let's just quickly talk about the main differences that you're going to get between an A and a B mortgage. So we'll talk about how A lenders qualify. So A lenders are generally for people who are salaried employees. They get a paycheck every month. They get their taxes deducted. You know, they make commission. We're using a 2-year average. And so these are kind of and you have good credit and your income is claimed to the CRA. Yeah. So your traditional employed client is generally who would fit the A lender box. Okay. Not to say that self-employed people aren't going to fit the B lender box, but.
Okay. In this market, how much income must you claim with the CRA in order to qualify for $1 million? Roughly.
250 grand?
Yeah.
Yeah.
So if you're watching this and you're thinking to yourself, I don't claim $250,000, you may be a candidate for a B deal. And wait until you see just how small the spread between an A deal and a B deal is in today's market. You're going to be surprised.
Right.
Salaried position with 2 years history. A lot of people in the past, I'll say, will contact Cannect and they'll say, well, I've got a job letter that says that I make $250,000. No, that doesn't work. It doesn't work. You need to actually have the income that we're putting on a mortgage application, right? I don't know why that's so funny.
This is the Wild West.
Yeah.
It's not the Wild West.
It's not the Wild West. You need to have the income, and it's not just for qualifying to get the mortgage. It's for the purpose of afterwards, you got to pay for the mortgage, right? And we need to put together a sustainable plan for the borrower. That's what our job is as mortgage agents. So keep going, buddy.
All right. So B mortgages. So this is your prime B mortgage candidate. So self-employed people, if you have multiple properties, banks and A lenders usually eviscerate rental income, unfortunately. And if you have damaged credit. So if you're in this box, and like we were saying, even if you are employed, depending on how much you want to qualify for or other metrics in your application, you may still be a B lender candidate. But in reality, most of our clients who are taking B mortgages are damaged credit and self-employed.
It's not just like that they're going to eviscerate the rental income from other properties. It's that they count it for less, but they count the expenses relating to those income properties for more.
Exactly.
It's very rare that an A lender will give any incremental positive associated with having another property to an application. They're always going to be a drag on your application with them.
Unless you have a ton of properties with no mortgages.
Unless you have no mortgage. Yeah. Unless these other properties have no mortgage. Yeah. In which case, you could probably just get an A mortgage on one of those other properties.
Yeah. Okay. So
this is a good slide, Justin. You did a good job on this one.
This is something I'm very passionate about. And I'm passionate about it because I have so many conversations on a daily basis with people who are self-employed. So here we've kind of put some information about what you need to qualify for $1 million mortgage. And a lot of my self-employed clients are saying like, well, how do I get there? How do I get a bank mortgage? How do I do this? Right. And honestly, it doesn't make sense most of the time. Right. If I'm speaking with somebody in the case of this illustration who wants $1 million mortgage and they're like, well, Justin, how do I get there? How do I get to this $1 million mortgage? Well, either you come to terms with the fact that we're going to do a B mortgage for you, or you pay yourself $250,000 for 2 years in a row, equaling a minimum of $82,000 in taxes, because that's the tax rate for $250,000.
I thought it was more.
Yeah, I mean, I pulled this right off the old government website.
Okay.
But that's
maybe I just feel like I pay more.
Yeah, probably that's it. And so that's 2 years, right? So $82,000 a year, that equals $165,000 in taxes paid over 2 years, or you take a slightly higher interest rate. It's a no-brainer, right?
How much higher?
Probably about 1%. So if we take $1 million, that's $10,000 a year. So it'll basically take you 16 years to make up the taxes that you paid on that mortgage. It's crazy. And then over here, we're talking about the B lender solution. So, there's, 1% in fees, 1% increase on a mortgage payment. And most people aren't going to keep their mortgage for 16 years, right? So.
Right, because you're going to refinance it every 5, or you're going to switch it or transfer it at least every 5. Yeah,
exactly.
I think that, I love the slide, right? I think that you could probably get an A mortgage approved for $1 million with a borrower that didn't make $250,000.
Yeah,
I think you could push ratios a little bit. You could probably get a borrower approved for $1 million loan that maybe made $200,000. Mm-hmm. There's a ton of creative things that you can do. You can add back things into the tax return that are expenses that were paid by a self-employed borrower. You can add contributory income from someone else that might be on an application. You can put guarantors on the file. We're going to do everything we can to get you an A mortgage, right? Like the whole idea behind calling a good broker is the broker listens, takes in all the information, and then helps you with the right path to getting the loan that you want. So if you're sitting there saying like, oh, I must need a B mortgage because I have only $175,000 in income and my wife only makes $50,000, or, whatever the case is, if you think that this is like a hard, fast rule, it's not. Mm-hmm. This is, however, a good tool to illustrate that B mortgages, they don't deserve the kind of negative connotation that they have. Right. And they are not much more expensive than an A mortgage. And on a kind of direct comparison basis, if you're self-employed and you're not claiming a lot of income, they are an incredible solution.
Yeah. And not to say that you won't have to pay any tax. There will be some tax.
There's always going to be tax.
Just not that much.
Yeah. There's always going to be tax.
Yeah.
So a fee to get a B deal done is 1%, and typically the rate is 1% over what you would pay on an A mortgage.
Yeah.
So it's 2 percentage points.
Yeah.
But the 1% that you pay as a fee would be deferred over the entire term of the loan. So if you're getting a 5-year loan, it's really kind of the difference is 1.2% because 20 basis points a year.
Right.
At 0.2 times 5 equals 1.
I like that. That makes sense.
All right, let's go to the next slide.
Okay, so we've got our direct comparison here. So we did some numbers. So
those are 5-year rates.
Those are 5-year rates. So 5.24 is kind of your best 5-year mortgage right now. If you're looking for $1 million mortgage, we do have better rates than this. I think our lowest rate is 4.49, but it definitely depends on what you're looking to do. So we're looking at 5.24 for an A lender and 6.34 for a B lender. So 1.1% difference. So I've done some calculations here. Interest cost differential is just over $10,000 over 5 years.
No, that's annually.
I've done the comparison and the interest rate.
That's okay.
Yeah.
Annually.
Yeah.
Like you can leave, like our viewer accepts you for who you are. Our listener appreciates who you are.
Yeah.
So let me just try to explain.
Okay.
What we're looking at right here are a comparison of the best 5-year fixed rate for an A mortgage, so a bank, and the best 5-year fixed rate mortgage for a B lender who would be like a trust company or, like Equitable Bank, Home Capital Group, Community Trust. Like there are so CWB out west, like there's a bunch of them. And they're all competitive and they all want to deploy capital and they're all more than okay trying to understand someone who's self-employed. And we are more than okay explaining someone who's self-employed to them. And as a result, again, those credit spreads have tightened. So think about it, right? Like that 5.24%, that's like a government of Canada bond in many cases to the prospective investor or lender. And the 634 is not far off of that. So they're really not attributing much of a risk premium to it. You did lie to us. It is 1.1% difference. And on a 5-year term, that's $10,700
every year.
Every year, in addition to $10,000 fee to the lender in order to get the deal.
Correct. Right. I almost fell off my chair watching back the old podcast of the Art of the B Deal version 1 because the B mortgage rate, and I remember having conversations with people going like, "Oh, that's so expensive. What are you talking about?" But the B mortgage rate, I think on that original podcast was 2.79%. I'd kill Austin for 2.79% right now on my mortgage. Maybe not.
No, you probably would. Okay, why don't we go to the next slide? Watch, now Austin's not going to switch the slides.
All right. So another style of B mortgage client or B mortgage candidate is one with multiple properties. We'll talk about this a little bit. So generally, A lenders are going to use 50% of your rental income to qualify your mortgage. So if you make $2,500, I have conversations all the time. Well, Justin, I make, let's make numbers easy. I make $2,000 a month on my rental. That's $24,000 on my income. That's not really how it works, right? Because they're only using 50% of that rental income. B lenders add 80% of the rental income and take out expenses, a portion of expenses.
Can't you also sometimes use market rents instead if the market rent is higher than what you're making?
Yes, sometimes, depending on the property.
B lender.
B deal. And also just saying down here that B lenders have higher debt stress limits. So, obviously you qualify for a lot more. If you took $250,000 in income and applied it to an A mortgage and a B mortgage, you're going to qualify for more with a B mortgage because they allow for higher qualifying ratios, basically.
Okay, so this slide basically just tells you what's happening, right? The market is changing right now. The average Canadian credit score has fallen. It's 672 right now. Threshold for an A mortgage is typically 680, although we can get exceptions done that will get you approved for an A mortgage with less than 680 as a credit score. Again, we're going to do everything we can to get you the lowest possible interest rate on a mortgage. But this is so that you understand that there are other alternatives. Like if you went to a mortgage broker and they said, oh yeah, there's no way we can get this thing done for you. Or you went to your bank and they said, we cannot get you a mortgage with an A rate. That doesn't mean that Cannect's not going to be able to get you a mortgage with an A rate.
100%.
We're going to do everything we can to try to get you into the lowest possible interest rate of a product that totally meets your needs. But if we can't, we're going to get you into a B deal. And more people are going to need a B deal. As you can see, right? Like 40% of Canadians are unable to keep up with their financial commitments. Another almost 40% of Canadians are spending more than they earn. And that's not just people that are going out for dinner and buying clothes for themselves. It's people that are trying to keep up with the pace of food inflation and debt servicing costs. We are in a very precarious position as an economy. And it's only further evidenced by this chart here, right? Like you can see GDP over the last 2 years has fallen off a cliff while unemployment rate and the household debt to GDP numbers are skyrocketing. This does not paint a great picture for the overall economy. And in a time like this, if you're self-employed, you have a few choices, right? You go to your bank and your bank says, sure, Mr. Self-Employed or Miss Self-Employed, we can get you approved for a mortgage, but I'm going to need you to claim more income on your tax returns next year. Because you claim $50,000, I need you to claim $250,000. You're either going to write a big check to Revenue Canada, or you're going to continue to operate the business the way you're operating your business with write-offs against the income that you're generating, and you're going to qualify for a mortgage with a B lender. And I think we can see from the slide so far that the net benefit to the borrower is greater. Again, great mortgage advice isn't always just this is what you need to do to get the lowest interest rate. Great mortgage advice is listening to a borrower and understanding what their time horizon is and what their objectives are over the next 1, 3, 5, 10 years, and then planning a product that suits it. I would guarantee you right now that there are a lot of people who are self-employed out there that are listening to this and are saying, it's crazy. I'm not going to spend an extra $80,000 a year in taxes to qualify for a new mortgage.
It's insane. It really is.
Yeah. And I'll tell you, I remember when I first started doing mortgages, the spread between an A mortgage and a B mortgage was 3%.
Wow.
It wasn't 1%. It still made sense. At the time that I took my first B mortgage, the spread was 3%.
That's crazy.
Yeah.
That's crazy. And was this in the 60s or?
Am I like that old to you?
No, I'm just joking. You're only a few years older than me.
Yeah. Jesus.
But I am younger.
Yeah. Don't look like it though.
All right.
Why don't you take this one?
I would love to. I would honestly love to. So assessing your situation and delegating where your equity goes. So if you need to pay off debts, Cannect is like we are, and most mortgage brokers should be, like credit assassins. Credit assassins. Today, I just made a phone call to a client. And if you're watching this, I'm excited to be helping you. But I made a phone call to a client. Her credit was 580 4 months ago. We got her some money to fix up her debt. And now her credit's 692. And we're moving her back to a bank.
Amazing.
Credit assassins, right? So making sure that your money is going to a place that is helping you better your financial situation so that we can move you back to being bankable, turning your unsecured debt into secured debt. Banks, I should say Equifax, TransUnion, these guys are a little bit more, I'm trying to think of the word. It's much more detrimental for you to be holding unsecured debt than it is to be holding secured debt, right? So taking debt, paying it out, and registering that to your property in one way or another is going to boost your credit, definitely, as I just mentioned from that.
Yeah, so to be clear, the way credit works is it's based on utilization. So if you have, right now, you're listening to this, and you've got a line of credit and a Visa and a car loan, the way your credit score interprets those accounts, if you only have those 3 accounts, let's say, is first it looks to see if those accounts are current. And if 2 of those accounts aren't current, then 66% of all your credit accounts are delinquent. Next, assuming all those accounts are current, it looks at the utilization of your credit. So if you only have 3 accounts and you say, well, I don't need more credit accounts, I don't want to spend any more money and I don't have a need for any more money. But out of the 3 accounts that you have, 2 of them are very close to the limit of credit that you are afforded on those accounts. it's another strike against you, and it will further drag down your credit score. So a lot of times what we'll do with a borrower when they come to Cannect is we'll take the unsecured credit and we'll register it against the house. So whether it's a home equity line of credit or a second mortgage or a new first mortgage, we'll try to take credit that's been sitting around on someone's credit bureau for too long and bring it off the credit bureau, secure it against the home, reduce the interest rate that the borrower is paying on it. And the moment you remove it from the credit profile, the credit score jumps up. Because now you have those same 3 accounts. 2 of those accounts have a 0 balance. Equifax and TransUnion interpret that immediately as stability and a good borrower, and the credit score shoots up. The moment the credit score shoots up, the pricing on your next loan decreases. So whether it's an A or a B mortgage, you're looking at a better rate because your credit score went up. The bank has no vested interest in explaining this to you. They do not care what your credit score is. In fact, if the way they have behaved historically tells us anything, they would prefer you have a bad credit score. And hear me out. This is why I say this. So a while ago, CBC Marketplace did an expose on the Canadian banks, and they sent in reporters to all of the different banks. At this point in time, the Canadian banks had created something called a collateralized mortgage charge. Again, independent to Canada, a unique financing feature that would only benefit the Canadian banks and no one else. Collateralized mortgage charges. People would go in to get a new mortgage from their bank, and they would get their home approved, and they'd get an appraisal, and the house would get appraised for $1 million. And the banker would sit across from this unsuspecting borrower and say, listen, Justin, we're only going to give you a $500,000 mortgage because all you're asking for, but we're going to register a charge on your house for 125% of what the appraised value of the home was, $1.25 million. And Justin would sit there and say, wow, why? I don't understand. That's what you would do. And the banker would say, well, Justin, this is just for your benefit. It's so that if anything happens in the future, if you lose your job or if your credit score declines, we don't need to do anything to reapprove you for that mortgage, and we won't have to deal with any pesky lawyers. You're already going to be pre-approved essentially for a $1.25 million mortgage. So we can give you as much money as you need after that, and you just come right here into the branch and ask me for it. Well, stupid Justin would mosey out of that bank with his $500,000 mortgage, not realizing that he has just pledged 125% of the value of his house to his bank. And poor Justin, stupid Justin, dumb, stupid Justin, would go get fired, very likely. And he'd go back to his bank, scratching his head again with his peanut brain and his pocket full of dreams. Okay, sorry. Sometimes I wish we could just have it natural like this. It's so much better.
Yeah.
All right. So Justin would go back to his bank and he'd be like, Mr. Bank Manager, I lost my job. I've been fired. And now I need access to some of that money that you tied up in my house. I need another $100,000. And the bank manager will click away at their computer or that's probably a calculator.
Yep.
And they'll say, Justin, unfortunately, now that you're not working, you don't qualify for the mortgage that we already gave you, let alone us giving you any more money. And Justin, looking very downtrodden, would say to the banker, is there anything you can do for me? And the banker would say, you know what? In fact, there is. I can offer you a credit card and a line of credit. And this has happened to so many Canadians that it's sickening. And that Justin would accept the line of credit. He'd accept the Visa. He'd say, okay, I'll use these until I can find work. And the banker will say, exactly. Use these until you can find work. And Justin will leave. And as he's looking for employment, he's diligently doing what his banker has told him to do. The person he trusted, the person who told him to get a mortgage from them, the person who told him to get a charge registered against his house for 125% of the value of that home. And he'll use the credit card and he'll use the line of credit and he'll find a job. The problem is by the time he's found a job and he's gainfully employed and he has enough income to qualify him for a new mortgage that would, in all likelihood, pay out all of the debts that he's got, his credit score would have been decimated because of the full utilization of the line of credit and the credit card.
Right.
And now, when Justin goes back into that bank, 2 things have happened. Number one, the bank has profited off of something called net interest margins. The bank has a charge registered on Justin's house for 125% of its value. Justin can't borrow money from anyone else. He's got a $500,000 first mortgage. He's got, let's say, another $100,000 in unsecured credit, which is really essentially secured by the charge that the bank has on the house. The only difference is that Justin's now paying an average of 12 to 16% on that additional debt. And now when Justin goes back in to get a new mortgage, the banker will have to tell Justin he can no longer qualify for that mortgage because his credit score is too low. So the bank has profited and Justin is further lost. Those are the customers that Cannect helps.
The full circle to that too is banks have brokerages now. So you know what? The bank is just going to get you a B deal at that point.
Right.
Right? They're going to get some sort of, alternative credit product to fix your situation that they basically put you in. And it's interesting that you mentioned that banker in this situation mentioned to Justin about the collateral charge, because generally the conversations that I have with my clients are,
they don't know.
What are you talking about?
They don't know.
What are you talking about? You know what I mean? And it's very...
that was the CBC Marketplace report.
Right.
They were going in and they were being told that they were getting a regular mortgage. And then afterwards, it was a collateral charge registered on their home. And I remember when this first started happening, we were breaking those collateral mortgage charges. And because the customers didn't know about it, the banks were paying to remove them. They were paying the legal fees to have them removed from title because there was such a bad stigma associated with these charges.
Yeah.
And you don't see them as much anymore because it's been fought back a little bit, but you still see them.
Oh yeah, 100%.
Yeah.
Most banks do it. It's yeah.
Yeah.
Anyways,
I thought that was a good little aside.
I like that. I mean, these two things we kind of touched on, right? Like lowering your month-to-month expenses. It's pretty obvious that if you're paying something these credit cards that you were mentioning, 19%, 20%, anything better than that is going to bring down your monthly payments, right? Like lines of credit at Prime, our lines of credit are at Prime right now. Mortgages, we're looking at 6.34 as a B mortgage. I mean, if you have a bunch of unsecured debt, it's you're obviously going to save a ton on a monthly basis. And then getting you back to the bank at the end of your term, which is what I mentioned in the beginning with my client, who we're sending an application in right now for, who was 580 Beacon and now it's 690.
How long did that take to go from 580 to 690?
Not that long, like 4 or 5 months.
Yeah. Credit repairs fast. So if you are sitting there and you're listening to this or you're watching this and you're thinking to yourself, oh man, it's a tough road. Like, I need money now and my credit score sucks and I'm not working or my income, I haven't filed my taxes, but you're bleeding with debt service costs because you're being taken advantage of by banks and credit providers. There's no better time to act, right?
Yeah.
We can help take some of that unsecured debt, pull it off of your credit bureau, start boosting your credit profile. Like we're dealing with hundreds of people every single month. And it would be rare for us to have not seen someone's situation before. We know how to solve them.
Yeah, absolutely. And we love solving them.
Yeah.
Or is that it? I think that's it.
All right, let's finish it off.
Well, I think that's the last slide. That was really fun. I had a lot of fun.
Yeah, it was great.
I do like talking about B mortgages. I do like helping clients fix their credit, and I like sitting here with you. So this is all very perfect.
Yeah.
I think we're gonna sign off for today, but it's been great. And don't forget to hit us up on YouTube, Instagram. Click like, hit subscribe, leave a comment so we know what to talk about on our next podcast. And until next week, make money count.
Thanks.